Welcome to The Path to Exit, a podcast to help software and internet founders understand the process to raise capital or sell their business.
Hello and welcome, everyone. I'm Mike Lyon, founder and managing director at Vista Point Advisors, and this is The Path to Exit. This show is dedicated to helping founders of software, AI, and internet businesses understand what it takes to raise capital or sell their business and how to do it well. My guest today is Jeff Bean, managing director at Vista Point Advisors. In this episode, we'll discuss the different likely buyer types in your transaction, from public strategic to standalone private equity firm and everything in between. Please enjoy my discussion with Jeff. Jeff, sometimes founders think about a transaction they're doing and they just think about it as a price and a transaction. They don't realize there's actually a lot of different elements to the buyer types they'll interact with, on everything from valuation to what life is like post-transaction. To get us started, can you just talk about the three main buyer types we see with private software company transactions?
So the three types of buyers that we see are, on one spectrum, public strategic acquirers. So those are publicly listed companies trading on an index, largely here in the US, but maybe internationally as well. And then the other spectrum would be a private equity or growth equity buyer, and they would be looking at a software company as a new platform investment. And then the in-between land is the PE-backed strategic. So think of those as large private companies. They could span from almost like size up to billions of dollars in enterprise value. So there's a pretty big range of outcomes in terms of what that buyer looks like. But that's a private company that is funded by one of the larger PE funds out there.
Yeah, great way to bucket them. And I think, as Jeff said, to some degree, the public strategics act somewhat similar to each other. There's obviously a range there. And the private equity firms kind of act similarly. On the private equity-backed strategic, we almost think of it as like a spectrum that touches both of those endpoints. So some of those private equity-backed strategics will act like a big public company, and some of them will act more like a standalone private equity firm, and you'll see all varieties in the middle. And so they're, in some ways, the trickiest one to analyze because sometimes there's not a lot of information about them. But the way we're going to structure this discussion is just talk through a lot of the things you'll run up against in a transaction and how to think about these three different buckets of buyers. So Jeff, the big question everyone has when they're looking at buyer types is valuation. So who's going to pay the most in a transaction? How does that work between these different buyer types?
So it really depends. I would say in any one instance, whether it's a public strategic or a PE-backed strategic or a PE platform standalone deal, there's scenarios where they all would see valuation pretty similarly. There's scenarios where a public strategic or maybe a PE-backed strategic would likely see synergy values and other aspects of the product and be able to price that in much more so and thus be more competitive on valuation. And then there's also scenarios where it's a high growth business and for whatever reason, the strategic acquirers within that category aren't really seeing the value as much, but you have these standalone growth equity funds, PE shops that do see that value and can price that in. And thus maybe a standalone transaction ends up being the highest valuation. I'd say one of the most important aspects to valuation, particularly for whether it's a public strategic or a PE-backed strategic, is how is that business valued? So if that business is valued highly in the public markets, say 10x multiple trading on the NASDAQ, they have a fair amount of flexibility in what they can pay. If that same business is trading at 3x in the public markets, they're not likely buying any asset for north of 5, 7 times, 10 times, because it's going to be dilutive to their valuation. And the same holds true in the private markets. Where that private company got priced at by their PE funder really impacts what they can pay for businesses and also where they expect to exit. So those are kind of aspects of transactions that we're always evaluating in terms of the buyers list and who we're talking to. And it shows up a lot more and is more obvious on the strategic side in terms of the valuation. On the PE side, I'd say the biggest inputs to valuation is really like the quality of the funds you're speaking with, and then all the inherent KPIs and dynamics that go into what makes a quality business and what prices accordingly that impact valuation.
Yeah, great points. And I think one of the ways to think about it is in any transaction, who could pay the most? It would likely be a public company strategic. So imagine a scenario where Google or Microsoft both had to have this asset. That would clearly get bid up a lot. And in theory, they could pay the most. In practice, it doesn't always happen that way. In fact, we see a lot of times a standalone private equity deal for a business that's somewhat disruptive and has really good KPIs. That one can actually trade higher because they feel like there's ability to go disrupt the market. So different situations where each of these buyers can win. And the public company strategic always has the ability to pay the most. But if you look at what's happened the last 5 years, that hasn't been the case because they don't really have to have a lot of these assets, right? It's more opportunistic. So I think it's important to just think about what's likely versus in theory what could happen. One thing that's closely related to valuation is what we would call quality of buyer. So, Jeff, for each of these different buyer types, how do we kind of evaluate the quality of that specific buyer in any given situation? What are you looking for?
Let's maybe take the public bucket first. I'd say the quality of buyer analysis on a public company comes down to how that business is valued, right? How are they valued in the markets? Thus, what can they pay? And then also, how acquisitive are they? Have they done a lot of transactions? Do they have a history of getting deals done? If it's a new public company that trades maybe at a decent multiple but has never done a deal, that public company is going to behave a lot more like a private company, frankly, in terms of their ability to get transactions done, just because they don't have the infrastructure to do that. On a PE-backed strategic, so a big private company that's backed out there that's private, the quality is really going to be more subjective. So it's going to come down to one, do we like that equity? Maybe some reverse diligence that we get done on that equity, understanding what that looks like. How many deals have they done? Who their PE backers are? How acquisitive have they been? All those aspects will impact the quality as well in terms of our assessment of them. On the PE standalone or growth equity funds, the quality that they look at is much more defined by the size of the fund, how many deals have they done, what's their history in that sector or category, how are they as a partner. All those aspects would really factor in. And then thus, do they have a history of paying multiples that end up getting deals done? If they're more different funds are active in different areas of the market in terms of what multiples they pay and what quality businesses that they're looking for. And so making sure that those kind of jive with the business and client that we're working with is really important.
The two things I would highlight that Jeff said that I think are really important is for a strategic buyer, if we could only have one data point to evaluate how good of a buyer they are, it would be their multiple. So if they're valued at 4x revenue, it's going to be really hard for them to pay 15 times revenue. It's possible if there's lots of synergies, or they just have to have it. But if you look at their DNA and how they think about valuing businesses, if they got valued at 4, it's going to be really hard for them to pay that. And then on the private equity side, just making sure you're talking to the right investors. So for example, if you're a really high growth software business, you want to be talking to the high multiple PE firms. You don't want to really waste time with some of the lower multiple guys because they're just not going to be competitive. However, if you're more of a slower growth business, but you have a lot of cash flow, you'll be wasting your time with the high multiple guys. They probably won't be that interested because they have a different profile that you're chasing. And some of those other investors who wouldn't be competitive in a high growth situation suddenly become really competitive because they're used to paying EBITDA multiples or valuing businesses in different ways. But I think we've seen a lot of founders waste time. They're really excited about a public company strategic and then just get lowballed. And there was never really a chance for it to happen. The other thing I would just say is in terms of sophistication of buyers, Jeff made the point of how much M&A have they done. You'd be surprised how many brand name companies out there that are public who really don't do any M&A, and they are horrible to deal with in M&A because they have no muscle memory. So they literally don't know how to do it. And the people who are in charge of doing the M&A don't really know how to do it. So some of, I would say, our worst situations in terms of dealing with buyers where they just don't know how to close the deal have been some of the bigger brand name public strategics who just don't have that muscle memory. Jeff, so let's maybe transition and talk a little bit about the different types of deal structures you likely see with these buyer types and how to think about that ahead of time so you kind of know what you're getting yourself into.
So the typical deal structures that we see out there are cash. Obviously, it's a critical one and always a component of the transaction. Equity or rollover stock could be a consideration as well, depending on who the buyer is. But let's maybe take the public company strategics. Those transactions are generally all cash. If we wanted to take equity, we could always buy the equity in the public markets. And so typically a transaction with a public strategic should be all cash. There could be a scenario where a public strategic tries to put something in earn out or some type of like deferred but guaranteed, and that could be up for consideration. Those are pretty big differences between those two. Just maybe talk about it a little bit. An earnout is consideration that's tied to some type of performance based on the company post-close. And in general, we heavily discount earnouts. We are not proponents or fans of those at all. It's very rare to have those, frankly, in our transactions. But if there is a big gap between valuation between seller and buyer, a strategic might try to place an earnout in there. Or if they feel like there's not a lot of competitive tension in the process, or if it's a one-off discussion, they might try that as well. With the PE-backed strategic buyer, that consideration would also likely be a big chunk of cash. There could be some equity rollover as well. And that equity rollover, just to be clear, would be in the acquirer. And so that's where, and I kind of hit this briefly earlier around reverse diligence, we would have different opinions on that equity based on the diligence that we do on it. And so not all private equity is treated equally. And so I think there could be different views on if we like that equity or not. And that could impact the type of consideration that you would see in a transaction, whether it's all cash or some type of rollover as well. On a standalone PE platform transaction, it's usually pretty straightforward there. Like it's going to be cash up front, and then the rollover equity is our equity, right? And so that's very clear how that works. You're selling a portion of the business as opposed to the whole business. You don't really typically see earnouts or other types of consideration in those cases.
And I think one way to think about this is the risk or the bet you're making, if you will, going forward. If you do a public company deal, you're likely going to get fully cashed out. And if you did take some equity, so let's say you rolled 20% of the business, likely you're selling to a really large strategic. You're really betting on the performance of that big strategic to determine your equity value because you're such a small percentage of it. On the opposite end of that is the private equity deal where you're going to own some equity, but it's in your business. So you're kind of betting on your business solely. And then if it's a private equity backed strategic, it's somewhere in the middle. If it were a really large strategic, it would look like the public company point we made. If it were a like-sized business, you might really be able to move the needle on the combined entity. So you're betting a little bit more on yourself. So it's just kind of where your risk and upside lies is important when you're thinking about that. So Jeff, maybe let's just hit some of the big ones here in terms of how we think about transactions. We tend to think about it from liquidity, upside, and control. So let's maybe run through where the differences are in those three concepts for those three buyers. So let's start maybe with the public company.
So with a public company acquirer, I'd say liquidity is probably maximized, right? That's generally going to be an all cash transaction. And the upside in that scenario is kind of gone, right? Because you've sold the whole business and you've sold it all for cash. That's maximum liquidity. In terms of control, you lost all control of the business, right? You sold it to a public company acquirer. And your upside is just the upside in that company's stock if you have it. But like we said, those are generally going to be all cash transactions.
In general, that deal is max liquidity, at least on a percentage basis, basically no upside and no control unless there's a different accommodation there. Maybe let's go to the other end of the spectrum, which would be the PE standalone deal. What do those three factors look like there?
Yeah, so the PE standalone is like maximum upside. Depending on how much of the business you sell, generally we see 30 to 80% as kind of the guardrails for typical transactions. So it could be a minority transaction or majority. And then obviously, if you sell less of the company versus more, you're going to have more upside versus less in the go forward business. And the control piece is also important, right? So you have maximum control in a platform transaction relative to any other transaction. And then the type of platform transaction that you do, if it's a minority versus majority, also has really big ramifications for that control piece. And so that's a constant dialogue that we're having with our clients around, okay, what are they trying to optimize for here if we end up doing a platform transaction? And then what are the trade-offs around control and upside and valuation in those deals?
One of the reasons why we've seen a lot of these types of deals over the past 5 or 10 years is when you compare the liquidity, sometimes on an 80% private equity deal, the liquidity might be a little bit less, or in some cases the same as a full strategic deal. So you're getting roughly the same amount of cash after the transaction, but you still have this upside in your business. You still own 20, 30% of the business. As Jeff said, it could be as much as 70%. So that's one reason why you're seeing people do those deals. They're getting comparable amounts of cash, maybe a little less, but they still maintain some upside. And Jeff, maybe address just the last buyer type there, that private equity-backed strategic.
Yeah, so the PE-backed strategic is kind of the hybrid. So you have given up control of the business, right? You sold the whole company. You may have gotten all cash. You may have gotten cash and some equity. And that's where the buyer profile really matters a lot in terms of who that buyer is. So if that buyer ends up being a private company that's frankly not much larger than your business when you sold it, then you don't have control, but you do have influence on the outcome, right? Your business will influence the outcome of the overall equity of the performance. If the private entity that you sell to is like a really large, think $1 billion private company, you're not going to really have that large of an influence on that outcome. And so you've definitely given up control, but you might have upside. And that upside would be in the form of the buyer's stock. Typically, like our clients go into these transactions thinking largely cash. And then depending on what that might look like in terms of who the buyer personas are, like it could differ depending on who the buyer is. We might have different perspectives on if we actually want that equity or we don't.
Yep, absolutely. Let's maybe transition a little bit and talk about just how the transaction plays out differently. And specifically, when we say speed of transaction, I would put speed and almost like buyer competence in the same bucket. Maybe talk to us a little bit about the differences you see there between these three buyer types.
So I would say in general, the spectrum on speed starts with the private equity funds. They're going to generally move faster than strategics, surely than a public strategic. And then the hybrid, the PE-backed strategics, it kind of just depends on who the sponsor is and what the transaction looks like. But I think they're probably somewhere in the middle. Now, having said that, there are exceptions to that rule. We have seen some public company strategics, for whatever reason, whether they had some kind of arbitrary aspect going on in the business, they wanted to get a deal done before maybe like a quarterly earnings. There have been scenarios where we've seen public strategics move lightning quick. But I would say if you're making generalities about buyer personas, the PE funds are used to moving fast, doing diligence outside of exclusivity, getting purchase agreements done quickly. They just generally have less hoops to jump through sometimes than some of the public strategics do on M&A committees, et cetera. And so they usually move faster, but that's not the only aspect that we're evaluating in the transaction, but it's definitely is an important one.
I would just say the way to think about this is the PE guys are deal guys fundamentally, and they move fast. And part of their sales pitch to companies is, hey, we can make this fast, right? We'll get through the transaction really quickly. In general, that's true. However, if you give them exclusivity too early, they will definitely take as much time as they can to diligence the business. But in general, they move fast. I'd say well-oiled public company strategics move somewhat fast. They just all have a day job. And most importantly, their key stakeholders have a day job. The only slight difference there is pay attention to some of these younger public tech companies who have a very powerful CEO, so maybe founder and CEO. Sometimes they act a little bit different than a big public company who has a big board would act. But I think in general, we see the more PE like it is, the faster it moves just because they're used to doing that. I would also say they're a little bit more sharky. PE firms are knowing for trying to play games and a process in a way that strategics don't always do, right? And I would say strategics change their mind less about deals because there's a strategic imperative to do a deal versus sometimes on a standalone private equity deal, they're just looking for the right deal. It doesn't have to be in a particular sector.
I think that's a great point because while we generally have a perception that speed kind of goes hand in hand with certainty of close, but it's not always the case, right? And so sometimes there's just inherent aspects of how these strategics work that impact their ability to do things quickly, but it doesn't necessarily impact their interests in overall fact that they want to close the transaction.
Exactly. Jeff, one of the biggest surprises founders have, I think, during the process is just how different the diligence process is and how different buyer types focus on different things in the diligence process. Can you maybe address how that's different amongst these three buyer types?
Yeah, it's a great point. So the strategic buyers, they are looking through the lens more of product. And thus, the diligence that they do on a transaction is much more product and tech. And they're going to do that in-house. They're not going to bring on market consultants or third-party kind of product folks. They're roping in maybe like a CTO or other folks internally, and they're going to want to be doing demos and doing technology diligence, all pretty upfront in the process relative to where the PE funds would do that diligence. And it's really like the most important diligence that they would do as a buyer. Strategic acquirers are also going to do like their accounting diligence and their legal diligence, but the product and tech diligence really matters to their interest level in the transaction and really informs their ability to pay and just their excitement in the transaction. On the PE side, like the other spectrum of that, they also do product and tech diligence, but I wouldn't put it as paramount relative to the strategic acquirers. The PE funds are much more financial driven. And so they are evaluating retention models, customer cubes, pipeline coverage, bridges to year-end projections. Their diligence is really more financial KPI driven, focused on the last 6 months and the forward 6 months as the most critical period. They will also do tech, product diligence, legal diligence, but they're going to be hiring third parties for that. The diligence they do themselves will be much more financial driven. They'll be hiring third parties for tech, market, legal, all these other aspects, which will be important, but not nearly as important as the commercial diligence they do on more like the KPIs and metrics.
And I think it literally will almost feel like night and day for you as a founder, depending on who you're dealing with, what they're focused on, when they're focused on it. And if you think about it from each of their perspectives, it really makes sense, right? Strategic buyers are buying you because they want your product. They want your revenue too, but if they're a really large strategic, it's more about, can we cross-sell this product or upsell this product? With PE firms, generally the types of deals we see is they're trying to evaluate, if we inject more capital into the business, can we grow faster? And usually that's on the sales and marketing side. If you don't have a good product or you don't have good retention rates, they're just not going to care anyway. But so they tend to be more focused on those financial metrics. Last point I wanted to touch on here is life after the transaction. So life can be really different if you stick around in a transaction. And Jeff, maybe talk about how that looks different across these buyer types.
So for a public strategic buyer, life after the deal for the founder might not be that exciting, frankly. It might be a great home for the company and the employees, et cetera. But given that, you sold the business, you gave up all control, you got all cash, likely in the transaction, there's not the same upside and usually excitement that we see from our founders. And so I'd say it's pretty typical that founders probably transition out over some period of time. There are scenarios where we do see our clients get excited about staying on, and maybe there's some really exciting kind of like way they can really grow the business and build the business up. But I would say across the board, it's probably the most likely outcome for a founder to transition out, just because it's just such a different beast to be kind of within a large public strategic as opposed to how you've been operating independently. The life with a PE-backed strategic looks pretty similar to a public strategic, although there could be big differences depending on who that party is. And so you have given up, obviously, control of the business, and you don't have a lot of say in some of the real strategic avenues of how you grow the business going forward, because obviously you sold the whole company. But depending on what the persona of that buyer could look like, if it's a smaller private company, it might look and feel not too differently than how it was previously when you guys were standalone. And then the last type of buyer profile was a PE platform transaction. That life after the transaction probably depends mostly on what type of deal you did. If it's a minority transaction and you sold 30 or 40%, that would look a lot different or would feel a lot different. The life after the transaction could be a lot different than if you sold 70 or 80% of the business. And so I'd say the biggest change in that scenario is you have a board now, right? You have a partner that you're working with. You probably have quarterly board meetings where you have some materials you're walking through. And that's probably one of the biggest reasons why partner fit becomes really important, particularly on a PE platform transaction, because you now have a partner, right, that you're working in conjunction with. And so making sure like the cultural fit works, that'll all impact the life after the deal a lot. And that's why that becomes such an important metric or important criteria for evaluating buyers at that stage.
Yeah, great points. And I think, at the extremes, let's say you sell to a public company strategic and you have no upside left in the transaction, you're likely going to feel not as motivated, right? You don't have as much upside. And frankly, you might feel a little bored, right? These are big companies that move really slow. You're not the lead product, right? You're the smaller company that they acquired. And sometimes we hear founders just get bored, particularly younger, aggressive founders just get really bored. On the opposite end of that, imagine a PE standalone deal where we really maximize the multiple. So it was a really competitive process. The PE firm really paid up. The folks who did that deal at the PE firm are going to be judged on that transaction. So that's much more likely to maybe feel more stressful. You're certainly going to have more upside, right? Because now you own a decent chunk of the equity. But that's a scenario where it could feel really stressful, particularly if the first couple of quarters don't go well and the PE firm feels like they're behind it on their return profile. So just not any one situation's right for all founders. Every founder is different, but those are kind of the extremes. And then obviously you can find all the flavors of that are in the middle. But today we talked a lot about the 3 different buyer types that you'll likely see in an exit. And we kind of analyzed them across multiple dimensions: valuation, deal structure, speed of transaction, diligence, and what life will be after the transaction. Jeff, thanks for your time. Great to have you back.
Yep, it's fun talking through it.
Vista Point Advisors is a founder-focused investment bank that advises software and internet founders through M&A and capital raise transactions. We are a fully unconflicted investment bank who only works for founders on the sell side, so you know that we're always representing your best interests. Securities offered through Vista Point Advisors, member FINRA, SIPC. This has been provided for informational purposes only. It is not intended to address all circumstances that might arise. Testimonials from past clients may not be representative of the experience of other clients, and there is no guarantee of future performance or success. Clients are not compensated for their comments. If you have any questions about the process of selling your business or raising capital, reach out to a member of our team, or check out the For Founders section of our site by visiting forfounders.guide.